Hey guys, welcome to my channel. Today we're going to be talking about the 6 criteria I look at in determining if an area or region is a good place to park your money and invest in real estate, where the chances of that property, if you buy it in that region, will likely go up in the future. I learned this through a mentor of mine who actually taught a class on this, and it's really helped me in my real estate investment career. So I hope it actually helps you out as well. So right now, there is a huge migration going on in the United States where people are moving to new states and cities looking for a better quality of life and a lower cost of living. In a sense, they're looking for more prosperity in their lives. So these are the places that you as a real estate investor want to invest for the future because they will likely go up higher versus relative to the rest of the country. In regards to the 6 criteria, all you really need to do is about 2 to 3 hours worth of research on the computer and a couple calls to see if it is a viable place for you guys to invest. So without further ado, let's get on to the 6 criteria. So criteria number 1, you want to see long-term migration of people coming into the area. It's a really important key factor. Real estate is governed by supply and demand, like many things. And you want to understand why people are moving to an area. There's got to be reasons for that. And it's really easy to find, actually. All you have to do is go to the Census Bureau or even just Google the area that you're looking at. You will obviously see many articles by the local media touting the growth of the area and its prosperity. So on the flip side, what you don't want to see is a lot of people leaving the area. That is not a very good sign for real estate and for its future prices to increase. But you also want to understand in your research why they might be leaving in that area. Now, if you do find a place that people are migrating out of, it's a definite red flag for you to actually mark down. So moving on to criteria number 2, job growth and business creation. This is another key important macro factor to look at when you guys do your research. Higher job growth equates to higher chances that the housing in that region will actually appreciate more in the future. So the questions I ask myself when I'm researching this criteria is what businesses or jobs are being created there? Are they high paying or are they not? Is the economy and the businesses within that economy well diversified? I think that's one of the key factors within this criteria that I look at. The higher the paying the jobs, the higher the capacity for the employees to pay for a higher mortgage payment, the higher the capacity for them to pay a higher rent. So this is one of the key factors I look at. So the information under this criteria is actually really easy to find. All you have to do is Google job growth. And usually local businesses and local media companies will tout all the attractive amenities or jobs being touted for that area. Another thing I do that helps my research a lot and makes it easy is I actually go to the economic development department for that city or that area that you're looking at. Their sole goal is to actually bring up the economy of that area. It's basically a one-stop shop to understand the economic activity for that region and what's driving the people moving there. They are touting a lot of things that are going on that are spurring economic activity and helping its citizens to create better businesses, to create better wages. So take a look at that. That's really helped me understand what drives the region for that area. So moving on to criteria number 3, quality of life. This is somewhat subjective, but you want to understand what are the attractive amenities for the area that you're looking at. Is it cultural, the museums? Is it outdoor life? Is it the weather? Is it the food? Is it all these things? You want to try to understand why people are moving there. Obviously, they're moving there for jobs mostly and to gain a better quality of life, but every region in the United States has its attractive amenities. So let's take Florida as an example. People are moving there for the sun, the weather, the outdoor sports, and the lower cost of living. If you look at all the articles written about Florida, it's actually one of the biggest gainers in terms of population growth in the United States. Now, the quality of life criteria is not as important as, say, the migration and the job growth criteria, but it is an important factor that I look at when I research an area. So moving on to the fourth criteria is that I look at reasonable house prices versus rent prices. And what I mean by that is that I want to invest in areas in terms of reasonable house prices where it has not matured yet or appreciated. I'm trying to be earlier than a lot of other people if I can help it. In terms of reasonable house prices versus rent prices, you want to try to achieve the 1% rule. Now, what is that? The 1% rule is a guideline very common in real estate investment circles. And what that means is that you want to aim for 1% of a month's rent relative to the cost of the house. I'll give you a very clear example. Say you're trying to buy a $100,000 house. We'll make it round numbers. Ideally, you want to get $1,000 a month in rent for it. Now, to be honest, there are a lot of appreciating markets where it's hard to meet that criteria. However, in cash flow markets, I'm sure you can meet in that criteria. There's a difference between cash flow markets and actually appreciating markets. I personally invest in only appreciating markets. So for me, it's very hard to achieve that 1% rule. However, I try to get as close to it as possible. I'll give you an example. I bought a house about a year and a half ago, and it was an appreciating market. I loved everything about that region. The house cost $157,000. But when I was doing my research, I knew that the sweet spot for rent was only $1,400 per month. Now, ideally, if I hit that target of 1%, that $157,000 house that I bought would garner $1,570 per month in rent. So in terms of that house I purchased, even though I didn't achieve that 1% guideline rule, it was still attractive enough for me to go buy because I totally believed in that area. Now, it's pretty easy to find how much houses cost for that area. You can go to Zillow or a bunch of these other sites and get an accurate depiction of what has sold and what's for sale. So how do I find good, accurate rent prices? Well, you can go to Craigslist and a couple other sites, but I'd like to do something else. I'd like to go make a couple calls to property managers that manage what I'm about to buy for that area and ask them. And why do I do that? Well, I think that they are truly the experts because they live it and breathe it every day. So they know the pulse of the market. They know if they are an expert in that city or that neighborhood, they can tell you off the bat exactly how much, say, a 2-bedroom, 1-bath or a 3-bedroom, 2-bath will rent for. And that's the kind of information that you really want to try to understand the rental rates for that area. So criteria number 5. Pro-business regions. I would like to ideally invest in areas where local governments make it easy for its citizens to start and sustain businesses. So places where there's limited red tape, where government's policies support their local citizens to start and upkeep their businesses, makes it easier for the people to be more economically successful. When people are more economically successful and the region is more economically successful, it can support higher house prices and higher rent prices. If you think about it, hardworking people just want a chance. They want a chance to support their family, to earn a good living. They want a chance to start a business and flourish and achieve that American dream. So they're moving to places like Texas and Arizona where they can start their own businesses with as little red tape as possible. As a contrast to these pro-business regions of the United States, we have California, which I think has been a victim of its own success. Due to the high costs of living, the red tape involved in terms of starting a business, the high housing prices, people are moving out of the state to more hospitable regions where they can get ahead in life. So we see clear examples of people migrating to these pro-business regions to get ahead in life and try to achieve that American dream. All right, the 6th and final criteria. Look at areas where there are lower tax burdens on its citizens. And what do I mean by that? lower property taxes, lower sales tax, maybe no state income tax. These are the areas that are attracting a lot of people these days. People right now are moving to places with less financial headwind. They want to keep more of their hard-earned dollars. And that's one of the very reasons why you see Texas, Arizona, and Florida growing and flourishing. As you can see, all the 6 criteria are kind of related. People are moving to areas where there's jobs, a higher quality of life, and a lower cost of living. Now you might be asking, does it really need to hit all the criteria for me to make a real estate investment? And the answer is no. However, the more check marks it ticks off on that list, the more I like the area. In addition, you guys might be asking which ones I think are the most important out of all the 6 criteria I talked about. Well, I feel that they're all connected and they're all important. But if I were to distill it down to just 2, look at the long-term migration of the area and job creation, job growth, and business creation. Those are the C's that you want to take a look at. So I hope you guys got some value out of this. Please take a look at my other videos. One I have on passive income and the other I have on stock market versus real estate market investing. I hope these 6 criteria actually gives you a good guideline to look at when you investigate areas to buy your investment homes. I'll see you on the next one.